Hello, this is the UCLA Housing Voice podcast, and I'm your host, Shane Phillips. We have two guests this week, Drs. William Cheung and Kelvin Wong, and we're talking about shared equity and limited equity homeownership programs in the US, UK, Australia, Hong Kong, mainland China, and Norway. Specifically, we're looking at William and Kelvin's work on the concepts of entry affordability and exit affordability. Shared or limited equity ownership programs provide financial resources to help people buy homes, and as such, they focus on entry affordability. They're about getting people onto the first rung of the homeownership ladder. As we usually envision it, the next step on that ladder is out of government-supported housing and into privately owned, unsubsidized housing. But shared equity programs often expect participants to pay back the money that they got to help buy the home, or they have to sell the home to someone else at a reduced below-market price. So that means they have lower exit affordability, and a lot of people who buy homes through shared equity programs can't build up enough equity to buy another home on the private market without support. They end up stuck in place or back on the rental market. As we discussed, there's no easy solution to this problem. Most people haven't even thought far enough into the future of shared equity programs to realize there might be a problem. We're doing that today, and there are a lot of really interesting angles to consider. The Housing Voice podcast is a production of the UCLA Lewis Center for Regional Policy Studies, with production support from Claudia Bustamante and Jason Suteja. As always, feedback and show ideas can go to me at shanephillips@ucla.edu. If you love the show, please give us a 5-star rating, a review, or tell a friend about it. Now let's get to our conversation with Dr. Cheung and Dr. Wong.
Kelvin S.K. Wong is professor and head of the Department of Real Estate and Construction at Hong Kong University, and Dr. William K.S. Cheung is a senior lecturer in property at the University of Auckland Business School. They're old friends and co-authors, so I'm very excited that they're joining us today to talk about shared equity and limited equity homeownership programs from a comparative international perspective, including the U.S. Kelvin and William, welcome to the Housing Voice podcast.
Yeah, thanks for having us.
Yes, thanks. Hello, everyone.
Don't worry, our regular host Shane Phillips is here as well. How's it going, Shane?
Hey, Pavo.
You're in good hands for this podcast. So Kelvin and William, we start each of our interviews by asking our guests for a tour in a city they know well, or just a visit to their favorite spot, whether that's their current home, town, or somewhere else. So maybe just take a few minutes. I was hoping Kelvin could mention Hong Kong and William could mention something about Auckland. Can you just tell us where you would like to take your friends or colleagues when they visit?
William, would you like to start?
Yeah. I can start first. Well, after my graduation from Hong Kong U, I decided to move here in New Zealand to start my career. And now I'm based in Auckland. That's why I'm talking about this most livable city around the world. I think it ran to be the most livable city recently on media. Apart from Hong Kong and also LA, Auckland is one of my most favorite cities that I so far live in. And if you come here to visit me, I can definitely organize some road trip to travel these cities, and it should be a very memorable experience. When people talking about New Zealand, they will quite focus on the South Island. You will have the Aurora or the glacier to visit, but what a pity that I may not be able to manage myself to visit South Island because of COVID. That's why I still haven't had a chance to go there. But having said that, before COVID, actually Kelvin come to join a Pacific Rim Region Conference, a regional conference in here in Auckland, and we managed to have a road trip to Lake Taupo, which is the southern part of Auckland. And that is a very famous natural hot spring area.
Nice.
You can enjoy the hot spring there. That's really fantastic view with the hot spring, and you can have your dinner, even you are having your hot spring. That's a really, really good place to go. And also in that area, you can also go to visit the Waitomo Gloomworm cave. You can see the fireflies.
Okay.
You can see all this is really a stunning view with a trip to that cave. Yeah, that's some place I would recommend.
Can I just jump in and say, I've never been to Australia or New Zealand, and we were actually scheduling another interview with someone from Auckland coming up next year. And in my head, New Zealand was always like right off the coast of Australia. But it's like 1,400 miles away and it's only 3 hours behind Los Angeles. This was just shocking to me.
Yeah.
So
yeah.
nothing, not a question
Plus
or anything.
also,
just
also William's talking to us from the future.
Yes, 21 hours ahead of us.
Yeah, that's true.
All right, Kelvin, how about you?
Right. So if I have to bring my guest to somewhere, originally I would like to say, Los Angeles, but now because Pavel asked me to say about something about Hong Kong, and also Hong Kong is the place I grew up and emotionally attached to. So I would definitely say Hong Kong. But I also understand here we have a lot of California U.S. audience. So I would like to say maybe you have come to Hong Kong or maybe you didn't, but it is actually a very small but densely populated city with a unique mix of Western and Chinese culture. So this is what I really like a lot. And actually, we can make a very good comparison with Los Angeles. You have Hollywood, and in Hong Kong we also have some of the best movie stars in the world. Particularly in the field of kung fu. Mm-hmm. Right. And, like UCLA, right, we also have some of the best universities in the world. So, and, maybe next to LA, you have another entertainment center, Las Vegas, and very similar to Hong Kong, right? Next to us, just 1 hour away by ferry, we have Macau, which is another casino and entertainment, center. So that would mean actually in a certain sense, LA, Hong Kong are quite alike. And that, because of all the great features we commonly have, it is not too difficult to imagine that, people like to come and live, either in LA or in Hong Kong. But that inevitably also creates some problem. Like, the topic we are talking about today is housing affordability.
Mm-hmm.
It's too nice.
That is a great transition. The paper we're talking about was published in 2019 in the International Journal of Housing Markets, and it's titled Entry and Exit Affordability of Shared Equity Homeownership and International Comparison. This is our first time talking about these kinds of programs, so this interview will function as both an overview of what these programs do and a discussion of the specific challenges with them that you're identifying and working with in your research article. We can start with what shared or limited equity homeownership means, and I think the frames of entry and exit affordability are actually really useful for explaining the purpose of these programs. On the entry side, the goal or a goal of these programs is to get people into homeownership to help them build wealth and improve their housing security, because as we all know, renting doesn't usually afford those same benefits. But buying a home often requires a big down payment, and people can't always pull that together without assistance. So these programs exist to provide resources in some way or another that reduce the buyer's personal upfront costs. We'll hold off on discussing specific programs or countries for now, except maybe as an illustrative example. But tell us, either Kelvin or William, at a high level, how shared equity programs generally handle that initial support and what strings are often attached to it.
Well, indeed, if you try to imagine yourself, you would like to buy the first home, but you only have a small amount of deposit. One option you could try to do is with the support of share equity partner. Well, basically, share equity arrangement can try to split the cost of financing home purchase into three parts, including your down payment, of course, and then your home loan from a bank. And then if your upfront cost is not enough to pay the down payment, then you need someone called equity share partner. Mm-hmm. Well, that equity partner basically will support you to finance your home purchase upfront. And the share equity partner could be anyone, even your parents. In New Zealand, we say we have a lot of media discussion on the bank of mom and dad. They also try to become the fifth biggest lender in this country, around 22 billion New Zealand dollars being involved in that mom and dad bank.
Wow.
Well, of course, our paper is not focusing on this bank of mom and dad, of course. We are more focusing on the government or any institution that helps to take the role, providing that share equity partner That means in the upfront, the government can try to support the down payment. Well, for instance, the Hong Kong HOS scheme, the home ownership scheme, is an example. Well, basically, Hong Kong government tried to build the houses and sell at an initial price discount. Well, like many other subsidy program, it usually have some constraint of that kind of share equity arrangement. Maybe your home need to be sold after a certain period of time, and also you need to sell to someone eligible to meet some annual income threshold. That is to ensure the household could access the housing or subsidized housing in society as a whole. That's basically how the share equity function.
That's super interesting, and I think it's important to distinguish between, the shared equity mortgage or some kind of financial participation, because I think a lot of times when people think about these kinds of programs, they're associated with the building type or a building stock itself, right? So usually the program is like a publicly built condo that's sold to people with a shared equity relationship, but it doesn't have to be. You could just have the government going in and helping people make their first down payment and then getting some equity at the end if they ever sell it, right?
Yeah, that's true.
And just to respond to Pavel's question on share equity mortgages, I think that may be more popular in the US, and people are more familiar with that.
Mm-hmm.
So if I understand it correctly, I think there is also one distinction between the share equity ownership and share equity mortgages. So I think William was right. It could be anyone who could contribute the equity part of the down payment. I think that's fine. It could be the government, it could be the bank. But I think if it is the bank, then banking is itself a business, right? It is not a charity. It is not something that they want to help the poor, but they have to make a profit. Mm-hmm. So that would mean the incentive of bank providing share equity mortgages would be quite different from what the government would do for share equity ownership. So let's say with the lesson from the subprime crisis, subprime mortgage crisis back in 2008. I believe now banks generally do not like to take too much real estate risk. That is not their core business anyway. And the problem is real estate risk normally increases with housing price. Mm-hmm. Right? And also affordability problem is more severe when housing price is high. So then you can imagine, right, when the price is high, actually the bank, now they are more conservative. They try not to do so much, kind of, mortgages, especially the share equity one, because if they do that, they will take on a lot of risk. Mm-hmm. So that would mean, when we get to a situation with very severe affordability issues, yes, the bank can provide equity, but they may not be very willing to do so, unless, they have, they can get a very high interest, they can, have a very good, share equity ratio. Otherwise, normal people, when they have to get finance, I guess, at the end of the day, they still have to go to the government, right? Right. In that sense. So that will make another, distinction in terms of the background of these two types of similar, kind of products.
Yeah, that's helpful. So the government, we're moving past entry affordability. The government has helped you buy a home, which clearly improves the entry side. But there's also an exit side. And for this, the goal of an exit means that people who participate in the program will eventually move from this subsidized housing situation into the private, unsubsidized market. Part of the thinking there is that it's good for people to be more self-reliant and fully own their homes rather than sharing part of it with the government effectively. Not to mention that it's just simpler and cleaner for them to own it, outright. But it's also beneficial because if the homeowners move into the private market and repay their subsidies, then that money can be turned around, reinvested to help someone else make the same journey from renting to subsidized homeownership to private ownership. But paying back that government support means you have less equity to afford a new home without subsidies. So exit affordability can be a real problem. Basically, selling your home may give you enough cash to pay back the government or whoever gave you that initial support, but not enough so that what's left after repayment can buy you a home on the private market. And that means you're either not going to sell and you're effectively kind of stuck in your home, even if your living situation, your job has changed, or you sell and you might end up living in lower quality home or less well located homes, at the suburban fringe or something. or you're back to renting, albeit with more wealth than you'd have had otherwise. Is there anything you want to add to that about this dilemma or the trade-offs that homeowners and the people who run these programs are trying to balance?
Maybe I try to use, as I said, Hong Kong is one of the examples using the share equity affordable housing home ownership. And that is a great case study to understand how this share equity arrangement having that trade-off. Well, under the home ownership scheme, HOS, implemented by Hong Kong government, they try to sell the new build unit to some eligible public housing tenant and with some eligibility requirement at a very generous discount price, usually around 30 to up to 50% of the market rate. That discount for a comparable unit in the private sector. That is the benefit of having this program, helping someone who can really get access to the home ownership. Of course, that it's subject to some resale restriction. At least you need to resell it after like 5 to 10 years once you live in that unit. That's why that will somehow restrict how you decide or make your decision to move elsewhere. Well, in general, you can imagine in Hong Kong, we have a very prolonged upward trend of property price increase in market. And suppose a lot of homeowners, they can get enough capital gain to move. But in the data that available to us so far, it indicates an extremely inactive resales market in those subsidized housing. Only around 1% of total subsidized housing stock being traded in that sector, while you can compare with 9% usually in the private sector.
Wow,
well,
that's a big difference.
Big difference. And you can see why even Kelvin and I try to ask why so many subsidized units are not being transacted. They remain frozen in that sector. Well, in other piece of our research, we try to advocate or put forward an argument that in terms of those share equity model, if you need to repay those down payment back to government in proportion, pro rata to the capital gain over a period of time, well, they are not really affordable to purchase a private housing unit in the private housing sector. That's why you may not be able to make an optimal moving decision making with that repayment. That's why it will create a lot of misallocation, as we named in another piece of work. Try to study that misallocation of resources among this subsidized home unit.
Can I clarify? You said there's often a sale requirement within 5 or 10 years. Like
I think you meant you can't sell it within the first 5 to 10 years.
You're restricted from selling it within a certain amount of time, but you're not forced to sell it. That was
I mean that's the whole thing. Nobody's selling them.
For one, that seems really harsh, and also it doesn't square with the fact that so few of these homes are being traded in any given year. Okay.
Well, and I think helpful. It's such a fascinating conundrum, because if you think from the government's perspective, one question that I ask myself is, why don't they just give people a bunch of money to purchase a house on the private market, right? And from the government's perspective, they don't want, the idea of the shared equity is when somebody sells that unit, their government's going to get some of the money back, and they can put it back into building more of these, or they can put it into the public rental sector or do something else with it. However, if nobody's selling them, they're still not getting that money back. So effectively, they're giving people a big one-time subsidy, but just the kind of subsidy that keeps them trapped in the same unit for a long time. Is that a correct summary of the problem?
I think it is. I think you nicely summarized the key problem of this share equity model. Right? People normally, for example, in California, Pavel mentioned about the social housing bill. So maybe people are now very actively discussing, how we should help the lower income people to get home ownership. But normally they don't think ahead. So maybe after they gain their own home ownership for 10 years, 15 years, then what happened after that? So do the policy objective want them to stay there forever, or do they do we want these people to move out to better places? I think that is something maybe at the policy making level people need to think more about.
Right. And have you been able to track the sales with different market cycles yet? Because you could imagine maybe it would have, in a down market, things might move differently in the HOS side of things compared to private housing?
Yes, I think we did. I think in our data set, we cover, maybe down and up cycles of the housing market. And so what William mentioned, 1%, 9% is just an average situation. But of course, in different market cycle, the two turnover rate could be different. But I think on average, I think as Shan mentioned, it is a huge gap.
Yeah, so the purpose of this study was to compare the entry affordability and exit affordability of shared equity ownership programs and do so in different countries. And the first step of that is just deciding which programs are going to qualify to go into this study. Could you talk about the three criteria you used to decide which programs would be studied and which kinds of programs in the US actually met those criteria?
Yeah, these three selection criteria include, first one is the program should have an initial lump sum subsidy for the potential homeowner to buy that property as a share equity partner concept that we mentioned. The second criteria is the program will involve some contractual arrangement with the predetermined price formula, how to preserve that affordability for future home buyer. What I mean is, as I said, there will be some resale restriction period, and also you need to sell it to some eligible income home buyer. That is something you need to consider in that kind of share equity arrangement program. The final criteria that we try to set in that paper is we need to have a clear policy objective from that kind of program that is helping some low-income family try to how to progress in the housing ladder. As Shan just mentioned, we need to move from the subsidized housing market to private housing market. That is an important criteria to enable that share equity homeowner to find an affordable exit to that program. That's why in that paper, you will see we didn't include Singapore, because Singapore homeownership program basically not really intend to establish the housing ladder. The government didn't intend really those homeowners to go into the private housing market. Over 80% of their population basically living in those public housing sector.
Right. There's not much private market to go into.
Yeah. That's the three main criteria we set out in our paper to select those countries to compare their affordability.
So there are three types of programs in the US that you identify that meet these criteria: community land trusts, limited equity cooperatives, and resale restricted owner-occupied housing. I'm not going to get into a lot of detail on this. I guess I do want to add, though, that I think another thing that qualifies is down payment assistance programs that, for example, the city of San Francisco has. I believe the state of California actually is doing this as well. My understanding of how it works in San Francisco is basically they will allow a buyer to put down as little as something like 3% of the purchase price, and the city will cover the other, 17 or whatever it is. And if that 17% down payment accounts for, 15% of the purchase price or so, then the city is going to take back 15% of the appreciation plus the initial amount when the homeowner sells. And so this is another, certainly they're sharing in the equity. And the one other thing I'll add is there are private companies actually that are doing this as well. Not necessarily banks, but maybe kind of more venture capital funded or whatever. But the terms, of course, are not nearly as generous because they have to account for the risk that the property value goes down. They also just need to make a profit. And so in those cases, it might be more like, they're giving you 17 or 20% for a down payment, but they're taking half the appreciation or 70% of the appreciation. It still can be a great deal for a buyer if they otherwise can't afford to buy. But those are just some examples. Pavo, did you want to talk about UC faculty
the one that I'm most familiar with is there's a canyon north of UCLA that has UCLA faculty housing that's a shared equity arrangement. And I do happen to know a colleague that's lived there for a long time and can't move because their share of the equity isn't enough to afford a house anywhere else in the city of LA. So I know a true person stuck in one of these.
He's living this story, yeah. I do want to talk about nomenclature here for a minute. When I think of things like community land trusts, which are they're made permanently affordable by public subsidies that never get paid back. And with those, my understanding is that they're usually called limited equity homeownership programs. And this could just be my misunderstanding. But the way they work is even when someone sells their home, they have to sell it at a below market price. But that initial subsidy is never paid back to the government or philanthropy or wherever it came from. To me, shared equity means that whoever gave you that money or discount to buy the home is eventually getting repaid, usually whenever they sell, the homeowner sells, and often they'll take a share of any appreciation on the property. And I say whoever here because even though we're talking about government subsidized programs in this study, there are these private companies doing similar deals. This might be a kind of nitpicky question, but do you agree with that distinction, or do you see things differently? Maybe this is just the fact that the shared equity kind of down payment assistance programs aren't as common elsewhere, and these are more government operated programs and even government built and operated housing in most other countries. How do you distinguish between those two different approaches? I feel like there needs to be some kind of distinction between programs that give subsidies to a housing project and require that the homes stay affordable indefinitely, which is sort of like how community land trusts work. Programs that give subsidies and let homeowners sell at market value eventually, but they require repayment of that subsidy. And so I think a lot of the international programs and these loan programs that I was talking about, for example, in San Francisco, that's how they work. And then there are programs that let homeowners sell at market value, but they don't require repayment. And I think those might be kind of rare, but I think they exist in some places.
Wouldn't that just be like down payment assistance? I mean, if there's no sharing,
it's just sort of a
equity,
grant, yeah.
Maybe I try to answer this first. Maybe Kelvin, you can supplement your idea as well. My response to Shane's question is, well, of course, it really depends. And when you ask us whether we see that differently, I think in terms of down payment, we have a lot of ways to engineer that down payment reduction for the home buyer. But I would say in terms of the equity arrangement, one thing is very important thing is how this subsidy inform. I mean, in the Hong Kong HOS case, because the government tried to build a house and they sell it at an initial price discount. That is basically the land premium of those subsidized housing unit. And I would say that kind of subsidy is more in kind relative to those down payment assistance scheme. They need to really pay out with cash. I mean, the major difference is about what is the form of that kind of subsidy. In terms of government in Hong Kong, they basically bear much lesser risk because when they just try to sell the home unit with a discount price, no matter what, the land is owned by the government. And they could scale up this kind of home ownership scheme with the land they own. Well, that is a major difference between the share equity arrangement in Hong Kong model versus those down payment mortgage or whatever financial arrangement that Shane you just mentioned.
Yes, I also think the distinction mentioned by Shane is actually very important regarding shared equity and limited equity. So I think conceptually, I think it is as simple as that. If the government just give you money to buy a home and without expecting you to pay back anything, it is a kind of subsidy, it's a grant, right? So that would be one arrangement. The second arrangement is that the government give you some money, but expecting you to pay some interest, which is predetermined, upfront. Then that would be more like a loan arrangement. So the government give you a loan to buy a home. And now I think what we are talking about is equity. So if we are talking about equity, then that would mean when you resell the home, the government is expected to take some share of the profit or loss, arising from the resale. So that would be what we call the equity approach. But I think a deeper question that Shane asked is what is the distinction between limited equity and shared equity? I think that's a very good question because I think this is also a question that we raised in the paper is whether shared equity home ownership would eventually end up with limited equity home ownership if people are not equipped with sufficient exit affordability and will never pay back the subsidies. But then that would become equivalent, right? When people do not move out, then they will always keep the subsidies without paying back, and that will be equivalent to a limited equity approach.
In your study, you need a way to compare entry and exit affordability for these programs between countries, and you rely on the housing price to income ratio, or PIR. And this is a basic measure where you take the median home price in a metro area or state or country and divide it by the median income for that same location. If the median home price is, say, $300,000 and the median income is $50,000, you have a ratio of 6-to-1 there. The price-income ratio is simple and easy to compare between different jurisdictions, but you also point out that it can obscure important differences based on taxation and welfare systems found in different countries. And I'll also note that places like Japan tend to have very high PIRs because they have very low interest rates by world standards. But when you look at what they actually spend on mortgages, they're much more affordable than the ratio makes them seem. And we can really feel that in the US right now, where interest rates are very high, and that's reduced buying power by something like 30% over the past year. But that point aside, to address the shortcomings or some of the shortcomings with this ratio, you developed a modified version of the PIR that tries to take into account some of these differences between countries. Specifically, the fact that buyers can usually purchase these homes at discounted prices, and the income requirements usually limit eligibility to people earning less than the median income. So the price is lower than the national or local median, but so is the income of the home buyer. Starting with entry affordability, I'll pose this question in two ways. First, for the US, how does entry affordability for housing in these shared equity programs compare to housing on the private market? And then looking beyond the US, were there any interesting findings for the other countries that you want to draw our attention to?
I think in responding to Shane's question, first of all, I think I'm not really the expert of US market, so I may not be able to answer how substantial of that discount or the initial upfront cost they can save with those share equity arrangement. But as I said, in the Hong Kong case, the HOS scheme basically can have the initial price discount up to 30 to 50% of the market rate. That's a huge amount that you can save from that upfront cost. And you try to ask the question with the Japan case. I would like to emphasize that the PIR, the price to income ratio that we try to invent in terms of those international comparison, we would like to emphasize that it should be a comparison of that ratio over time within a country that will try to indicate how the affordability change within that jurisdiction. That will be a more comparable or like comparison when we try to study those PIR.
So it's not so much comparing, Hong Kong's PIR to the US PIR. It's comparing Hong Kong's PIR for like market housing to its shared equity program housing, but also then comparing its PIR for the shared equity program entry and for the exit.
Yes.
Got it.
I think that's exactly the point. I think our paper's methodology is based on the premises that we cannot compare the PIR, the price to income ratio of different cities directly. I think that's the premises. So what we do is actually, as William said, we are actually first of all compare within a city over time. So that's number one. And the second thing we did is more like, academically, we call that a difference in difference approach. So another thing we do is even within the same time period for one city, we compare the PIR of the private market with the PIR of the subsidized market. So that's why we can look at the difference between the two at a particular point in time, and then we can see, now the affordable housing market is, maybe 5% better, than the private market. Then now we move on to another time period, maybe where we have a housing boom. Then we look at the two again and see, whether the affordability gap between the two markets have improved or not. So that is, how we conceive, our methodology in the paper.
Could you give us a sense for just ballpark between different countries, how big a discount these shared equity programs provide relative to market housing, and how that discount on the entry affordability specifically changed over time during your 10-year study window?
When we try to refer the paper, there's a table try to show different countries their entry and exit affordability, like China, Hong Kong, Australia, UK, US, and Norway. And you can see that the initial purchase discount or that subsidy of equity is basically ranging from 30% to 57%.
Wow, Norway, 57%. That's a lot.
Yeah. And you can see in that table as well, you can get a sense that when they get exit affordability being calculated, you will see that Hong Kong is one of the most unaffordable one when you compare with the private market.
Or I can also give a sense of another way to talk about the number, so because maybe the audience will be able to understand better what that means.
Yeah.
So William, I will first talk about entry affordability first, because I guess Sean will talk about exit affordability later on, right? Right. So to answer Sean's questions, I think, yes, we can refer to the table in the paper. And actually what we use is the price to income ratio. So like, taking Hong Kong as an example, for the private housing market, the PIR is 18, meaning, the housing price is 18 times of our annual income for a normal household in the private housing market.
Which, just to note, is the highest, or at least one of the highest in the entire world.
Yes, if we compare with other cities.
Other developed countries, yeah.
Right. And then for the shared equity home ownership program, so if we do the same, PIR in that sector, so basically the households paying, the PIR is 17. So meaning the housing price of this subsidized home ownership program is 17 times of the annual income of these subsidized households. So you can see 18, 17. So still, we have some improvement of the affordability, but it is not a great deal, right? So that's what we saw from the paper.
And that's despite having a 30 to 50% discount, because the buyers just have much lower incomes than the median.
Exactly.
Yeah. Okay.
And so like the UK was maybe the biggest difference, where, the market one was 4.5 times somebody's income, and then the shared equity program was 1.2 times somebody's income. So the shared equity is a really, really good deal in the UK.
Yeah. And how about with exit affordability? Just how did you calculate that, and what did the results look like for different countries?
Well, we tried to do a simulation how those subsidized homeowner, if they need to repay back that initial purchase discount to the government, how those price to income ratio looks like after the 10 years time window for those resales. I mean, with 10 years time, basically a lot of resale restriction will be lifted. People can freely trade it on the market. And we would like to simulate a price that the homeowner need to repay back part of their equity or capital gain back to government. What will the price to income ratio looks like at that exit point? That is basically how the exit affordability being calculated in this research work. And we try to get that simulated PIR compare with the market. That is the way how we compare different figures.
And what did the results look like in different countries for that exit affordability metric?
I can talk again about Hong Kong, right? We mentioned that 18, is the average for the private housing. So then, when we look at the simulation, mentioned by William, after 10 years living in subsidized housing, so will they be more affordable to exit to private housing or not? And the PIR we got is actually 24.
Wow.
So meaning after, living in the subsidized housing for 10 years, they are even less affordable, if they really want to go to the private housing market. I think one reason for Hong Kong is very obvious. The housing price in Hong Kong has risen much faster than our income.
So yeah, because it's a combination of that factor, kind of the housing price changes, as well as how good of a deal, how much sharing the program forces you to do, right?
Yes.
Did you consider looking at just assuming it was a grant, how would exit affordability look? And the reason I ask is because that 18-to-1 price income ratio that existed at the beginning for the market housing, that's assuming median income. But these households, they came into the homes with below median incomes in Hong Kong, well below. And so if they're exiting with lower incomes as well, then of course, their PIR, it's going to be hard for them to have a low PIR. Even if they got all of the money from that sale and didn't have to pay back the government, like, what would it look like for them? Would they still not have enough just because their incomes were too low? Or, what's the situation there, if you have any data on that or just kind of intuitions about it?
We may not have the actual data to reflect that, but conceptually, when you try to live in a subsidized home ownership, one thing that we need to point out is the homeowner actually can save a lot of rent when they cannot have that ownership. They need to rent elsewhere to live. But throughout the period, if they have home ownership assisted by the government, and they are actually having some kind of conceptual subsidized rent for them to accumulate enough wealth so that they can exit the program. That's why I would say when they try to exit the program, although the price is really increasing dramatically in Hong Kong, but at the same time, I would like to point out there will be some saving from those expensive rental expenses throughout the temporary time, as we assume in this study.
Yeah, I mean, even if people have to go back to renting, they're probably walking away with quite a bit of wealth because they paid down the principal on their mortgage, and they're keeping whatever appreciation. It's better than not having been in the program. It's just you're not necessarily getting into kind of the next step. I want to pull a quote from your paper really quick and sort of interrogate it here. You say, quote, "Although the fundamental policy goal of shared equity homeownership programs is improving housing affordability, many policy discussions that support subsidizing homeownership focus only on the improvement of entry affordability while ignoring the importance of exit affordability, which is the ability of subsidized homeowners to transition from subsidized housing to private housing," unquote. You follow that up a bit later by saying, quote, "Fundamentally, a well-functioning property ladder has to ensure both the entry and the exit affordability of households. Otherwise, the ladder will lead only to a trap," unquote. I have mixed feelings about this, and I guess where someone lands on it, like what position they take, will come down to whether they agree or disagree with the idea that the housing ladder necessarily needs to continue on up to private housing out of that subsidized housing market. On the one hand, if people can gain enough wealth, and Pavo talked about this a little bit, if they can gain enough wealth to move into the private housing market, and that's what they want to do, that's great. Assuming the subsidized housing that they've left behind remains affordable, then it's opening that rung on the ladder to another household, which is something I think we all want to see. But on the other hand, if under the existing limited equity structure, most people can't get to the point where they can exit to ownership on the private market, then it's hard to see how we solve that problem without giving those limited equity owners or shared equity owners a bigger windfall. So in other words, eliminating the requirement that they pay back the public subsidy. But if we do that, then that means that the subsidized home is going to be sold at market rate or something close to it, so it's no longer affordable. And in either situation, the household that first bought the subsidized home is the only real beneficiary, either because they stay in the same subsidized home forever or because they take the subsidy with them when they sell. And just, it's their money now, basically. So this seems like the real challenge at the heart of your research and shared equity homeownership programs generally. And I do think it's a really important insight. I'd just like to hear a little more about how you think about the trade-offs between these two different approaches or goals of these programs.
When I discuss this research work with Kelvin, we also see the trade-off among the limited equity and share equity approach. And we have a feeling or consensus that no policy is perfect. That's why there will be trade-off, and it is always referred as an impossibility welfare theorem. We cannot satisfy with all the people's need and concern. And I think for the share equity approach, we can really ensure an equitable access of public money for assisting those moderate income group to get access to home ownership. And why we should have this share equity approach because those are taxpayers' money. Government is accountable to ensure that kind of resources are really allocated to those who are need to access the home ownership. But it is very difficult to maintain the exit affordability for those subsidized, in particular in the share equity approach. People, if they cannot really go out or their moving decision is really hugely affected by the repayment back to government, it will create another layer of misallocation. As I mentioned, one of our previous research work that tried to study the misallocation of those subsidies in Hong Kong HOS market. Basically, those share equity approach also create a lot of mismatch among the sector. Well, just imagine if you really get a job, just using San Francisco as example, if you live in San Jose or elsewhere, but you get a job in Bay Area in San Francisco. If you're stuck in that kind of subsidized housing unit, you cannot move because when you repay back the equity to government or any entity, you basically cannot afford to buy anywhere in Bay Area. That's why you need to see how's the objective of the policy. What is the main objective of that kind of share equity arrangement to decide whether it is better to use the share equity approach or limited equity approach.
I think all I would like to add is that what Cheung mentioned is exactly what has been happening in Hong Kong. So Cheung mentioned, owners need a bigger windfall so that they have incentive to move out, right? And so exactly that was what the Hong Kong government did a few years ago. So they waived some of the, subsidized homeowners requirement to pay back the subsidy. So with that, waiver policy, so we could see a lot more transactions, a lot more liquidity in the home ownership, subsidized home ownership market. But the question is whether this is one-off or not, right? So this time you give them a windfall, right? So now they are willing to move because they do not have to pay back. But then for people who now move into the subsidized housing market, of course they now have to pay a higher price, as you said. And then what happened after another 10 years? Mm-hmm. So what if we want them to move out? And at that time, what kind of windfall can you give them or can you guarantee them? So it is still a question mark. So we do not know. So this is just a more recent policy. And so we might need more time to figure out, whether that could be sustainable or not.
Yeah, it's almost like a good political strategy, though. You can pretend it's a shared equity program. Then 10 years later, you just actually turned it into a grant program, effectively. The other point I was going to make is I wonder within the HOS system in Hong Kong, it's like 20% of the housing units in Hong Kong, something like that. Can you buy and sell within that system without taking a hit in the equity? Because you could imagine a kind of a parallel shared equity stock that could have mobility. You get a job in a different city, but you can sell within the system if there's units available within the shared equity stock there, right? And so sort of like trading flats or buying and selling flats without kind of taking the equity out of the system.
So unfortunately, in Hong Kong, as far as I know, there's no such flexibility. But people have always been talking about it. It's not so much about accessibility because Hong Kong is, as I said, it's a very small city. It
still takes a long time to get from Sha Tin to Hong Kong.
But that's the emotional hurdle, I think. Even though Hong Kong Island and Kowloon is just 5 minutes away, people think this is very long. This is a long trip.
Right. People adapt, yeah.
But then I think the other issue about, it's not about accessibility, but it's more about, either upsizing or downsizing the home because of our life cycle consumption requirement. Yeah. So for example, when people get older, maybe their, children have moved out, then they do not need such a big home. But now there is no kind of, internal mechanism for these, older people to, or maybe I can exchange my bigger home with a smaller one and then, get some cash back. I think there's no such arrangement, but I think that would be, very, necessary if we want to reduce the inefficiencies in the current subsidized system.
Yeah. So you need a big enough stock to make it flexible, but then it's like creating a whole parallel housing market that may be more trouble than it's worth.
I would be remiss if I didn't also just mention that part of the problem here is that we're trying to use housing as a way to build wealth in the first place. And the way that is done is by making it more expensive for the next buyer in real terms, which you can't keep doing forever. There's an upper limit where that just stops working. And it means that every time the government supports a household to buy their home, it's going to be more expensive. And again, there's upper limits on that as well. So I don't think we have to dwell on that, but it's just worth mentioning that this is somewhat of an unsolvable problem so long as prices keep rising. Like these trade-offs are inherent. But with that said, coming to a close, just thinking about reforms to at least improve on these programs, it seems like any reform that could be suggested is going to involve benefits for some people and costs to others, even if that's, just the government writ large. Under the current structure in most countries, the subsidy stays with the house or has to be paid back, which negatively impacts exit affordability. But if you let homebuyers keep more of the subsidy, then that leaves less funding to support other people in the future, which means reduced entry affordability. You do propose a tweak to shared equity ownership programs, which you describe as, quote, unbundling the deadlock between the right to live in a subsidized home and the right to enjoy a housing subsidy. Could you say a bit about that proposal and how you think it would help?
Maybe I can start first and then Kelvin can add more. We try to advocate a way that is try to let the people carry the in-kind subsidies to buy the housing unit in private market. Basically, they are still subsidized by the government with that subsidy, but that is the way how to maintain that subsidies still being some public taxpayers' money, while on the other hand, it still subsidizes some people who really want to move out from or exit the share equity program. They can still allow to have the budget to buy the private housing unit in the private housing market, like pay as you go for those subsidies in the private housing market. And it will be more sustainable, in particular when you mention how the public resources being allocated efficiently.
Right. So maybe another way to put it is because I know that maybe the U.S. audience is more familiar with housing vouchers. So in a way, the idea is very similar. So imagine that you are now a subsidized homeowners, living in that sector for 10 years. Now you're going to move on to the private sector, and one of the hurdles that we have mentioned in our conversation is that we have to repay the government, and so we are not able to afford private housing. So what can we do? So that would mean now we kind of suggest that instead of repaying the government his fair share of equity, what the homeowner will get when they resell the property is a housing voucher. So that means instead of repaying the amount of money to the government, you are holding a voucher. So meaning that when you go onto the private market, of course you have your own capital, and then on the other hand, you also have the housing voucher to help you, support you to move on to the private housing market. So that is basically what William said as the pay-as-you-go idea.
That's interesting. So it's not the case that the government would then own some equity in the next house you buy? Is that how you're thinking about it?
That is something we keep open. I think maybe when that person will sell the private housing, maybe after 10 years, then yes, I think the government could, also get a share of that appreciation.
Kind of like a lien on your next house.
Yeah. Exactly. Yes.
That would be bad for the bank of mom and dad, though, because then the kids won't get that money.
Bank of Mom and Dad often has very generous terms. All right, Kelvin Wong and William Cheung, thank you so much for joining us on the Housing Voice podcast.
Yeah, thanks.
Yes, thank you. Thank you for having us.
You can read more about William and Kelvin's research on our website, lewis.ucla.edu. Show notes and a transcript of the interview are there too. The UCLA Lewis Center is on Facebook and Twitter. I'm on Twitter at Shane D. Phillips, and Pavo is at L Pavo. Thanks for listening. We'll see you next time.